No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking about a lot of things today. I was going through a number of articles that I'm going to share with you today that are going to be helpful, I think, on giving some perspective on what we can expect over the next 5 to 10 years with regard not only to the economy, but with regard to the markets, interest rates. There's a lot of great information that I'm going to share with you that you're going to be able to actually apply in ways to help improve your situation and make sure you're not going to run out of money in retirement. One of the things I was reading recently, and this was from Consuelo Mack, a recent article in hers, and it came from the Financial Times. It stated that the International Monetary Fund's latest financial monitor reported that world debt is at record levels. You're talking $152 trillion. That is more than 2 times the size of the global economy. And here's the part about that. An official at the IMF warned excessive private debt is a major headwind against the global recovery, and this is the most important, and a risk to financial stability. Okay, so when we've got these high debt levels, and we know we've got it here in the United States, but this is around the world, what we're looking at is the increase in financial instability, if you will, then a decrease in financial risk and more risk then to financial stability. This is the other part. They show that the rapid increases in private debt often end up in financial crises. Well, we've seen that, haven't we? We saw that back in the last financial crisis. What was behind that? Debt. Okay, and that's mortgage-backed securities. Well, now they're saying financial debt, again, is at records high. Private debt is increasing. Therefore, the concerns are that another financial crisis may be upon us. Also, as reported by Consuelo Mack, the frequency of banking crises has increased in recent decades and have originated in different places. So we've seen that, right? We've seen it in Latin America and Asia, here in the United States, and in Europe most recently, of course, talking about Deutsche Bank, among other things, negative interest rates that are going on overseas as well. So these waves of banking crises, which also involve wide swings in currencies, stocks, and real estate, right? Bubbles. What are we seeing? Overpriced markets. We're seeing things with accommodative policies of the Federal Reserve that are creating these bubbles as well. What happens when those break? Well, we've seen that, right? Many times. We've seen it most recently, of course, back in the financial crisis in 08. So, what else do we know about this? It means that it's more important than ever to have a plan. These are riskier, more volatile times, and the financial crises have though they've been a fact for centuries, according to economists, we're starting to see them occur more rapidly, okay, more frequency here. Now, here's the other part. How does all this play into planning? There's so many parts to this that we're going to try to get into, and it makes it very difficult when you're getting mixed messages. All right, one of the things that, for instance, that comes into play, you'll see a lot of articles, on TV, right, or in magazines. Fisher Investments talks about how I hate annuities and how annuities are bad. And J.D. Melberg talks about, being careful in the stock market, how people lose tons of money and how you need to protect your money. So one's pushing that, you need to be everything in the market and avoid annuities. The other's pushing, no, you need to go with annuities and avoid the market. And, of course, the truth is usually somewhere in between, isn't it? There are tools. That's all these are. And tools, when used properly, can be very beneficial. Improperly, they can be disastrous. And this is one of the areas that it's more important, and that's why I lay out this part about what's going on in the world, to understand it's more important than ever to have a plan and to understand how these things work. Here's some other things I've shared with you before. BlackRock. This is the largest money manager in the world. BlackRock manages the Federal Reserve, the Federal Employees Thrift Savings Plan, among others, all right? They see a global portfolio of 60% stocks, 40% fixed or bonds, all right, which is very typical. A balanced portfolio, some might have a 50-50, some 60-40. What they're saying, this would produce a global portfolio now, not just the S&P, but a world portfolio, international, the whole thing. So this is a typical type of diverse portfolio that we would look to see for most investors in terms of accomplishing the goals of not running out of money and staying ahead of inflation and taxes. So a 60-40 portfolio producing annual returns of just 3.3% in U.S. dollars, and that's before inflation. And that's over the next 5 years. Excuse me. Mr. Turnell wrote in BlackRock's most recent weekly market commentary the outlook is even worse, with U.S. assets expected returns around 3% after inflation about 1%. Basically about treading water, breaking even in the stock market with tremendous volatility that you would have to deal with as well. And we've talked about volatility before. I'm going to share with you some things as well, both from Tony Robbins' book on Money Matters, Money Master the Game, 7 Simple Steps to Financial Freedom, and in my book, of course, 7 Steps to Financial Freedom in Retirement. One of the things that we're talking about that we're going to get into here is talking about the importance of sequence of returns and how those can impact you in terms of your retirement, how it could make the difference between having enough money to attain and maintain your standard of living and quality of life or running out of money completely. You know, there was a time in the 80s and 90s, for instance, and this is reported recently in the Wall Street Journal by Kelly Green, say goodbye to the 4% rule, all right? We used to, in the 80s and 90s, we would say that your distribution rate, keeping in mind that back then you were getting double-digit returns in the stock market, you know, in moderate portfolios even. But what happened? We could say you could take 4% a year and never have to worry about running out of money. That stock and bond portfolio would last forever, and you could take out 4% a year consistently. Well, what are we seeing today? If they're talking you're only going to make 3% on your money, okay, before inflation, and only 1% after inflation, does that mean I can only take out 1% and be able to keep my spending needs up with, or my income needs keep pace with inflation? $1 million would only produce $10,000 a year in income. $500,000 saved would only produce $5,000 a year in income. That's not going to go very far when you look at what's going on in the world with regard to pensions. And we're going to talk about this some more and try to put this together and then show you that there are ways that you can in fact protect yourself, and it's utilizing both the stock market as well as annuities together. And I'm going to share some research with you that shows that those two categories, asset categories if you will, when put together, give you the best odds of never running out of money. They put the odds in your favor, if you will. All right. We've got some slides I'm going to share with you. One of them, Fed's low interest rates, because this is the other part, right? It's not just that we've got what's going on in the stock market. We've also got record low interest rates. And there's another article I'll share with you, Interest Rates Lower for Longer, and it's talking about an aging population, low productivity growth, and a need for more deleveraging rather. In other words, all that debt we're talking about, getting rid of it to keep but because of these things, it's going to keep a lid on interest rates for the foreseeable future. So what do? We in the market, right? Low interest rates have caused people to take more and more risk in the marketplace, and even money managers and mutual funds, it's the same thing. We're also seeing them taking more risk in the types of strategies, if you want to call it that they're employing, especially in the fixed side, the bond market. And this is an area that there's a lot of risk in portfolios that people have and they don't even realize it. And I see it each and every week, because when I meet with new people and they bring in their portfolios and I go through them and do an analysis for them, they're amazed that, when I show them, look, inside, we pull a Morningstar report and we can see what that fund's holdings are. We can see, for instance, on a bond fund, and what the credit quality of the bonds are. So people are amazed to see how many junk bonds that they own in their portfolio, for instance, or long duration bonds that are very interest rate sensitive, so that they've got a lot more risk. And this is where this volatility, these bubbles, that's where it's going to come back to burn us. So we're going to talk about this and more. First, we're going to take a quick break. Join us here. We'll be right back on the Retirement Report.